Opening with a challenge. What if the biggest growth opportunity of your lifetime isn't hiding in the stock ticker you check every morning, but in lines of code on a blockchain ledger you've never heard of? Imagine this. While many of us continue to split our savings between stocks, bonds, and bank accounts, a quiet financial revolution is unfolding, one that could redefine what investment means for the next generation. Tonight, I invite you to peer beyond the familiar world of equities and fixed income and consider a new frontier: digital assets. Part 1. Why the traditional approach may no longer be enough. For decades, financial advisors have encouraged diversification across stocks and bonds, a prudent strategy rooted in modern portfolio theory and the lessons of past generations. Stocks offer growth potential, bonds provide stability, together they form the backbone of many retirement portfolios. But we live in an era of accelerating technological change, shifting global demographics, and evolving economic structures. Several forces challenge the traditional model. Inflation and currency devaluation erode real returns. Interest rates remain low in many economies, reducing bond yields. Economic shocks, pandemics, lockdowns, geopolitical crises create volatility that can weaken traditional asset classes. Growing digitization. More of our lives, work, communication, entertainment, is now digital. As the world becomes increasingly digital, so too does value. In this new landscape, holding only stocks and bonds may leave investors underexposed to the most dynamic growth opportunities of our time. That's why digital assets deserve serious attention. Part 2. What are digital assets? When we say digital assets, we refer to a broad and evolving category of investments that exist primarily or entirely in digital form. These include, but are not limited to, cryptocurrencies, e.g. Bitcoin, Ethereum, tokens built on blockchain, utility tokens, governance tokens, stablecoins, non-fungible tokens, NFTs, representing digital art, virtual real estate, digital collectibles, tokenized real-world assets, e.g. tokenized real estate, tokenized commodities, other blockchain-based assets and future digital asset classes, DAO tokens, digital securities, decentralized finance instruments. What unites them is a common principle: value stored, transferred, and managed through decentralized digital ledgers rather than centralized intermediaries. Part 3. Why digital assets matter today. Let me highlight 3 compelling reasons why digital assets are more than a fad, they are a structural shift. 1. Democratization of access. Traditional investing often requires barriers: capital for real estate, creditworthiness for business financing, intermediaries for high-value assets. Digital assets dramatically reduce entry thresholds. With a small amount of capital and internet access, almost anyone can own and invest. This democratization echoes a broader pattern: technology breaking down barriers, enabling broader participation. As blockchain pioneer Andreas Antonopoulos once argued, cryptocurrencies allow financial inclusion for the unbanked. 2. Liquidity and global reach. Digital assets trade 24/7, across borders, without the limitations of local markets. Unlike real estate, which may take weeks or months to sell, or bonds, which depend on trading windows, many digital asset markets are always open. Moreover, blockchain-based ownership allows global participation. An investor from Hanoi can own a fraction of digital art, a tokenized property, or a decentralized finance (DeFi) position, all on the same platform as someone from New York or London. 3. Innovation and high growth potential. Digital assets represent the frontier of financial innovation. From decentralized finance to tokenization to programmable money, These are not iterations of existing systems but entirely new architectures. With innovation comes opportunity, early adoption, high growth potential, and the chance to shape the future financial landscape. Part 4: Real-world examples and emerging trends. To make this concrete, let's look at a few real-world manifestations of digital asset investing. Cryptocurrency, digital gold and beyond. Cryptocurrencies like Bitcoin, BTC, and Ethereum, ETH, remain the most well-known digital assets. Bitcoin has often been compared to digital gold, scarce, decentralized, and resistant to censorship or centralized control. Others, like Ethereum, support smart contracts and host entire ecosystems of applications. For many early adopters, these assets have not only preserved value but delivered extraordinary returns, albeit with volatility. For investors willing to understand and weather cycles, crypto offers a radically different risk-reward profile than traditional stocks or bonds. Tokenized real assets. Blockchain tokenization allows real-world assets, such as real estate, commodities, or even art, to be divided into digital tokens. These tokens can represent fractional ownership, enabling investors to own a portion of high-value assets at far lower cost and with increased liquidity. This model could democratize access to investments that were historically reserved for wealthy individuals or institutions. Digital collectibles and NFTs. Non-fungible tokens, NFTs, have gained attention for digital art, but their significance goes far beyond. NFTs represent digital ownership and provenance. They could become key to virtual real estate, intellectual property, licensing, and digital identity. If virtual worlds and metaverses become more mainstream, ownership of digital assets may become as valuable as physical property. Decentralized finance, DeFi, new financial infrastructure. Decentralized finance, lending, borrowing, yield farming, liquidity pools, replaces traditional financial intermediaries with code. DeFi offers opportunities for yield, diversification, and financial engagement that were previously unavailable or accessible only to institutions. For those willing to learn and engage, DeFi represents a radical rethinking of finance, one rooted in transparency, decentralization, and algorithmic governance. Part 5: Risks, volatility, and what you must understand. Of course, no investment comes without risk. Digital assets, perhaps more than any other asset class, come with unique challenges. Volatility and market cycles. Prices of many digital assets can swing wildly. While volatility offers the potential for high returns, it also increases the risk of significant loss. Markets for crypto and tokens are still young and often driven by sentiment, news, and speculation. Regulatory uncertainty. Digital assets exist in a shifting legal landscape. Regulations can vary drastically between countries, and new laws or restrictions can impact value, liquidity, or legality. Security risks. Unlike traditional assets, digital assets often rely on self-custody. If private keys are lost or stolen, or if smart contracts are improperly coded, value can vanish. Lack of historical data and institutional framework. Because digital assets are relatively new, long-term performance data is limited. Unlike stocks with decades of dividend and valuation history, many tokens and digital assets lack deep historical records. Behavioral risks, greed, fear, FOMO. With rapid cycles and high volatility, it's easy to get caught up in hype, chase price spikes, buy when everyone else is buying, and sell in panic. Without discipline, investors can suffer heavy losses. Part 6: How to approach digital assets with intelligence. Digital assets are not a shortcut to riches, but with the right approach, they can be part of a smart, diversified, Future-oriented portfolio. Here's how to proceed wisely. 1. Educate before investing, understand technology, protocols, and assets. 2. Start small. Diversify broadly, don't put all your capital into one token. Spread risk across different asset types. 3. Use money you can afford to lose, especially at first. Treat early investments as exploratory, not core savings. 4. Hold long-term. Avoid trading hype. Resist urge to chase fads. Focus on fundamentals. 5. Protect keys and use security best practices, hardware wallets, secure keys, strong passwords, awareness of scams. 6. Combine digital assets with traditional assets, maintain a diversified overall portfolio, part traditional, stocks, bonds, real estate, part digital. 7. Stay updated, the space evolves rapidly, regulations, technology, market sentiment, all change quickly. Part 7. Vision for the future. Digital assets as part of a balanced 21st century portfolio. Looking ahead, digital assets are unlikely to replace stocks and bonds entirely, but they can and probably should take a growing share of a forward-looking investor's portfolio. As the global economy becomes more digitized, value shifts will reflect that transformation. The lines between finance, technology, and creativity blur. Ownership becomes more fluid, fractional, global, and digital. For those who adapt, this period may represent one of the greatest generational opportunities to build wealth not just through traditional means, but through innovation, inclusion, and new forms of value. Conclusion: a call to open your mind, not just your wallet. Ladies and gentlemen, I am not here to tell you to dump all your savings into crypto, NFTs, or digital tokens. That would be reckless and irresponsible. What I urge you to do is this. Open your mind, educate yourself, understand the evolving nature of value. Because investing in digital assets isn't about trends, it's about the future. A future where value, ownership, and finance are redefined. A future where you have a chance to participate, grow, and thrive. If you approach wisely, with knowledge, discipline, and humility, digital assets can become a powerful complement to traditional investments. So tonight, I challenge you, don't just look at your portfolio. Look at the horizon. Beyond stocks and bonds, there is a vast landscape of possibility. Will you stay anchored in the old world, or will you step into the next era of financial opportunity?